I think it will be a great time to be long commodities because I think the penny will drop to people that the Fed is in a kind of no-win situation, and they're going to have to, quickly drop rates. They're going to have to print more money. They're going to have to NQT. They're going to have to increase their balance sheet again. And this might be the time, finally, that people decide, I want to own commodities, not stocks. Even though there's normally an initial fall in gold because it's liquid collateral. And so people liquidate their gold to meet losses elsewhere. It's exactly what we saw in 2008, and it will happen again. You will see this initial fall in the price of gold. All the dynamics for me in terms of being a bull on uranium are there. I want to own the asset itself, and I want to own really well managed uranium companies, and those have had a hell of a run. So I think you need to pick your jockey in those companies, and choose the right management team and the right assets. The reason central banks are buying gold the way they are goes back to Russia crossing the border into Ukraine and the response by the US Treasury, which was to freeze $300 billion of Russian central bank assets.
Grant Williams, it's an honor to have you on our podcast. You've spent over 3 decades working in the financial world, and over that time you've worked in Japan, New York, London, Hong Kong, Sydney, and Singapore. And given that wealth of experience, I wanted to start by asking if the current moment that we're living through in 2024 reminds you of anything that you've seen before.
Oh boy. Well, first of all, thanks for having me. I appreciate it. I would save the how honored you feel until the end of this. So you can rethink that if you like it when we hang up. But does it remind me of things? Look, there's little bits of other periods, but there's a whole lot of new ground here for me. I think if you pick any point in time apart, you can always find parallels. Depends how hard you want to look for them. So, we can look back to previous inflationary periods to get a sense of what's happening there. We can look back to previous equity market bubbles to get a sense of what's happening there. We can look back to previous periods when rates were rising quickly to get a sense. You can always find parallels and find analogs going back, but I don't remember a time where we've had all of these things happening at the same time, and a lot of them are counterintuitive, and throwing into the mix the fact that we're in this incredible moment of political upheaval, which we really haven't seen since probably the late 70s. Um, it's I hate using the word unprecedented, but certainly in my career, I don't remember a time when there have been so many different cross currents, the vast majority of which are have potentially negative effects on asset prices. The only real positive we have going for us at the moment are the prices. And that's a problem to me because the prices can change very quickly when sentiment changes, and there are plenty of things that could affect sentiment negatively. So that tells me that prices could go the same way.
So would you mind then just giving us the lay of the land as you see it right now in 2024?
Well, look, I think it's this has been a long time coming, and I've spoken often to nauseating length to a lot of people about Neil Howe and Bill Strauss's book, The Fourth Turning. I think that is it's such an important read for people now in terms of understanding where we've been and previous periods of upheaval like we're in now, and that as a backdrop to all this, understanding that humanity and society are cyclical things, and we are at a point in the cycle that repeats over and over again. We just happen to all have come along and been here at the stage we are in our lives and careers at the moment it's happening. If we'd have been born later, it just would have meant we were younger when it happened. It's not necessarily a product of us. It's a product of 80 years of progression and cyclical habits being reinforced. So that to me is the backdrop to all this, is understanding that take markets away, take asset prices away, take central banks away, take all these things away. This is a humanity cycle that is playing out, and it, we don't change as beings. Men make the same mistakes over and over again, and sadly, the nearest kind of reminder of that for all of us is to see what's happened in the wake of the October 7th Hamas attacks in Israel, and to see, you know, young kids throwing bricks through Jewish cafes in the streets of Paris. You know, as someone in their 50s, as I am, late 50s, um, I learned about the run up to World War II. I wasn't there, obviously, and my father, who's here with me now, he's 85 now, so he was born at the beginning of World War II, so he wasn't alive. So to have any memory of those events, you have to be 100 years old.
Mm.
So there aren't any memories, and the stories have died, and people don't learn that particular part of history anymore. People don't like to talk about the rise of the Nazis, and so you can see why these things happen over and over again. And so this fourth turning, this political upheaval that feels so deeply personal to all of us caught in the middle of it, um, is just something that happens, and we have to go through it. And we have to go through that process and have the cleansing period when people get sick of the corruption and the poor politicians, and they tear down the institutions that they no longer have faith in. And we get to rebuild society all over again in a new image, and that's always an incredibly good time to be around. So we just have to get through this, and I think once you understand that and you realize that it's not all about markets, I think when we doing what we do, we get wrapped up in thinking that markets and asset prices are the most important thing, when the truth is they're absolutely not. They just happen to be for us. And so those asset prices are going to ultimately reflect the broader social landscape, the broader geopolitical pressures, the shifts in those geopolitical tectonic plates. They're all going to be reflected in asset prices at some point, um, just not yet. And that's absolutely fine. And it's okay for people to be invested and try and stay on the ride as long as they can, as long as they want to. But the deeper into this full turning process we get, the shakier the whole system becomes, and the more likely it is that a seemingly irrelevant event, like we saw in 1914 in Sarajevo, can can create the spark that sets the whole thing off. So I think
Mm.
having an understanding of that, an understanding of how precarious the situation is, particularly with the elevated level of asset prices, and realizing just how far they potentially could fall, is the best you can do. Being blind to it and assuming that nothing's changed, assuming that buy the dip still works, and assuming that central banks will always be able to save things. I just think that's a very dangerous mindset to have going into this next phase.
So you mentioned that book about the four turnings by William Strauss and Neil Howe, and I've also seen in your writings and speeches that you mentioned Kondratiev's waves as well. And sort of both of these fit into what you call long wave theory. But for
Yeah.
people who haven't heard about any of this before, um, what does it mean that we're in the fourth turning? Could you give us a quick primer on those ideas and
Yeah.
spell out what the relevance of those are for understanding where we are right now, in your view?
Yeah, by all means. Yeah, Bill and Neil wrote this book. They published it in 1997. And it was a look back, in most part, rather than forwards, at the cycles of history. And they identified these clear 80 to 100 year super cycles that were split into, four 22 to 25 year mini cycles, turnings, they called them. And they traced them throughout history. And the fourth turning, which is what we're in now, happens every 80 odd years, and it's a time of crisis. And it happens when the public get tired of the corruption, they get tired of the institutions that they've lost faith in, they get tired of the system not working or being rigged against them, and they want to tear these things down and start again. And so it's characterized by financial crises. The Great Depression, Wall Street crash happened in a fourth turning. Um, World Wars, American Civil War happened in a fourth turning. World War II happened in a fourth turning. So they tend to be crescendos of public angst and rebellion against the system, and they tend, unfortunately, to end or encapsulate some kind of major conflict. And of course, as we've gone through the in '97, Bill and Neil said that the next fourth turning would begin roughly around 2008, and it would likely begin with a financial crisis. That tends to be how these things materialize. And of course, right on cue, along comes 2008, um, and the idea that this period could culminate in some kind of major conflict seemed fanciful. Back in the 90s, even with the conflicts in kind of former Yugoslavia and the Middle East and Iran, the Iran wars, Kuwait, all those things happening around through the 90s, it seemed fanciful that we could have a broader conflict. And in fact, I've spoken about this before, but I gave a speech in January of 2015 talking about exactly these Kondratiev cycle. I think this is probably the presentation you're referring to.
It is.
And the war cycle. And I went back over the history of conflict through the 18th and 19th centuries in Europe, when there was a war every 20 minutes. If you didn't like the war you were in, just hang on half an hour, another one will come along and you can join in that one. And we had the major powers of Europe, the Germans, the French, the English, the Spanish, fighting with and against each other all the way through those 2 centuries, switching sides and switching allies, and there was constant conflict. And so at that point in time, it didn't seem fanciful there could be a major conflict. Post World War II, we've gone now best part of 75 years without there being some kind of major conflict. And of course, that fits perfectly with this 80-odd year cycle that Neil and Bill wrote about. So the fourth turning is a time of crisis. It's a time of breakdown of society. It's a time of loss of faith in politics, politicians, and institutions. And unfortunately, it's a time of conflict. And so, here we are with Russian soldiers crossing borders in Ukraine and mainland Europe. We've got the belligerence of the Chinese over the Taiwan Strait. We have America pulling back from Afghanistan. We have all the embers necessary for these conflict fires to begin all around the world. And, for the first time, really, in my lifetime, you're not really able to say there won't be another major war. Now, I'm not saying there will be one. As I said in that speech in 2015, what I'm saying is there's not going to be one. And that's a material change. So, understanding that and understanding that whatever else happens, we just happen to be in a time of crisis now, and options are on the table for how this thing plays out that previously we didn't have to worry about. So we as investors need to think about them because they will dramatically affect our portfolios as and when they play out.
Do these cycles, though, happen at a global level or just at a national level? Because, for example, the first turning for the US was, according to that book, the economic boom following World War II, the period that you might say Trump supporters are nostalgic for. But at the same time, China in the early 1960s under Mao was going through the Great Leap Forward, which was marked by social breakdown and widespread famine. So, assuming these cycles do occur, but only at the national level, do they have much relevance for predicting today's globally integrated economy, or is this just a US-centric theory?
No, I think that's a terrific question. Obviously, World War II was not a US-centric event, and that was the culmination of a last fourth turning, and that was very much a global event. And so, there are all kinds of cycles that have been identified through history. Kondratiev is one of the long cycles, but Juglar, Schumpeter, their Kitchen, there are all these guys who've come up with different length cycles. There's a war cycle. There's all kinds of different cycles that have been identified. And what you tend to find is you can overlay them, and there are points in time where they all tend to kind of come together, and they're the periods you want to watch out for. And that's kind of where we are now. And since that last fourth turning, as you rightly point out, that China has been very different, but the world has become a lot more interconnected and become a lot more global. And those cycles tend to kind of sync up together as we do that, because the impact that America has in its actions upon China have increased dramatically since 2000, the World Trade Organization. Obviously, that changed things in China significantly and probably accelerated their own cycle. So there isn't one cycle to rule them all. It's not like Lord of the Rings, and they're an imprecise science. I think the point is that the people who've tried to observe them have been what we all do, particularly in this business that we're in, is try to find repeating patterns that we can reliably use to predict the future. And these cycles of varying different lengths, and some people will tell you such and such a cycle I swear by, and this one just doesn't work. they're not hard and fast rules. They're observations that are backed up by periods of history that you can choose to follow and choose not to follow. For me, the fourth turning, the framework that Neil and Bill put together is very broad, and it does try and encapsulate mankind cycles, not a certain country, not a certain market. It's this rise and fall of humanity. And I gave a presentation last year and looked at a series of paintings by a guy called Thomas Cole, a painter who was English guy who lived in Catskill, New York, who did this series of paintings depicting this rise of empire and the fall of empire, and showing how cyclical they are in nature. And it was very much a kind of a wilderness that turned into an agrarian society, that turned into a Roman Empire, that turned into chaos and destruction, and turned back to a wilderness again. And he painted those in the 1800s, based on what he'd observed from reading Greek and Roman history and reading the other history available at the time. So this isn't a new idea. This is not something that Bill and Neil kind of had this aha moment, went back and suddenly found something that hadn't been observed before. But as I say, everything is cyclical, including memories and the historical data that people think are important at given times. And we're in this moment now where people are looking for understanding in, why is the world so chaotic? Why does it feel like we don't understand what's going on? We don't really feel like there are politicians that represent us. We don't feel comfortable. There's conflict everywhere. There's chaos everywhere. Why is this? And so finding these frameworks that you can point back and say, look, it was like this back in 1929. It was like this back in 1945. That first turning you talked about, of course, ended right around the time Kennedy was assassinated. This death of this hope from this rebirth. So, as I said, they're not precise science, and people should feel free to completely discount them if they so choose, if they think they're nonsense. And there are plenty of people that do. I just happen to think that a couple of hundred years history and the knowledge that I think that we all have, that human nature doesn't really change, gives them a weight in my mind that is certainly worth considering, put it that way.
I understand that these cycles usually last about 80 years, or about the lifespan of a person. And one of the explanations for that is the idea that without those people left alive to tell us about the horrors of war, for example, we run headlong into repeating them again. But is that really how information is spread nowadays? Because I'd say that I've learned 99% of what I know about World War II from documentaries and films and books, and perhaps 1% from stories that my grandparents told me. So in the
Right.
kind of current information era, is it really still true that we need that generation to be alive to actually tell us about these things?
Well, let me ask you a question.
Hmm.
Those books, those documentaries, uh, who put them in your hand and told you to read them or watch them?
Well, not my grandparents. I mean, it's more something that's embedded into society, isn't it? In any school history curriculum, World War II
Ah,
is one of the
well, there
main
we go.
things. Yeah.
So that's a question, and that's an important question, because for me, you're right. All the information is out there. You can absolutely go and watch documentaries and read history books and understand what happened in these periods of time. My conjecture is that people don't tend to do that. People don't. I think you'll find that you are an exception to the rule of someone who wants to, in his spare time, watch history documentaries and read books about World War II.
Hmm.
I don't think those periods of history are taught so much in school anymore. Certainly not the way they were when I grew up. Certainly not watching movies that were made in the aftermath of World War II, telling about the battles, the famous battles that kids won't watch today because half of them are in black and white, and they're not in 4K. And who wants to watch the Battle of the Bulge? I mean, it doesn't mean anything. So I think the story aspect, stories are how humanity passes on its knowledge. They always have been, and there is now both this ease of passing on stories through the internet, through digital archives, but there's also the problems that causes, because there is just so much in those archives. You have to go looking for World War II history if you want to understand it. And so I think it's important that these stories, that when you learn these things from your grandchildren, and no, once you get, or grandparents, sorry, once you get a couple of generations away, those stories necessarily and understandably kind of get diluted. The generation whose parents grew up in the Great Depression had those memories seared onto their brains, and that absolutely colored the way they thought about debt, the way they thought about the world around them. Um, the boomer generation, obviously growing up in the wake of World War II, had a very different mindset. The Gen X generation, growing up as kids of boomers, had a very different mindset. Millennials, Gen Z, you have these different mindsets, but my grandkids now, who are 2 and 5, you know, they won't be old enough to really understand the experiences of my father, their great grandfather. You know, he's 85 now, and I spent a wonderful day back in early November with him in France, recording an interview with him that I want to be able to play to my grandkids when they're older, so that they hear him telling the story of what it was like growing up in the aftermath of World War II, and what it was like growing up in the 60s and the 70s and the 80s, and understanding his life and the conditions. Because I think without him telling that story, albeit on video, uh, they're not going to really be able to understand what life was like. And I look now at the distractions that the kids are placed in front of the kids, in terms of the entertainment options and the Netflixes and all these things. I don't see many kids on buses now reading books, reading history books. I see them on their iPhones texting, and I see them playing games. And so, yes, whilst all this information is available, it's sadly, for the most part, incumbent upon people to want to go and find it. And it's there, but you've got to want to go and look. And I don't see a tremendous desire on the part of young kids to understand how we got to World War II. You know, there's a tremendous podcast in the UK, which you may have heard, called The Rest is History. Two English historians, one classical and one modern historian, and they just do an hour, 45-minute podcast every week talking about an episode in history. And they did a terrific 4-part or 5-part series a couple of years ago about the rise of the Nazis in Germany. And you know, when you listen to this, as someone who grew up when I did, my thoughts were always, how on earth did this happen? How did the world let this happen? How did this guy get elected? How could Germans not see what was going on? How did they sleepwalk into World War II and the Holocaust? And listening to that 4-part podcast, which walked you through from the end of World War One, the Treaty of Versailles, which, you know, I understood that, I knew that history, but I didn't understand the steps that went from the Treaty of Versailles and the bitterness that built up among the German people and the hardships they suffered in the end of World War II. This podcast put it all together. And when you finish listening to that story, your mindset is very much, how could this not have happened? It all makes perfect sense that this guy comes along, this charismatic leader who plays into all the insecurities of the German people, who gives them a scapegoat, points and says, all this pain you're feeling is their fault. And I walked away from this podcast going, geez, of course it happened. And that's why when you see what's happened in the wake of these Hamas attacks, you realize how easily it could happen again, because enough time has passed. And that's why these cycles are so important. The time has passed. It's almost right on the bell. 80 odd years has gone by. No one's around to tell those stories. And if you want to understand it, you have to go and look for a podcast, or go to the library and look for a book, or go on the internet and search for stories about what happened then. And it's incumbent upon us to want to learn rather than us being taught, and that's problematic.
Hmm. But if the fourth turning that we're living through in this moment kicked off in 2008, then that means we're fairly close to having already done 20 years of it. So at what point do you say that was it? That was all the death and war and pestilence. And now it's time for the first turning. It's time to be bullish. It's time to start adding lots of equity exposure. At what point
Yeah.
are you going to say we're out of the fourth turning? We're in the
Well,
first one again.
isn't that interesting? And it is for a lot of people. It's, when do I add equity exposure? You know, and this is much, much bigger than that. That's really not the thing here. If let's say it started in 2008, and by Neil's and Bill's framework, it'll last 22 to 25 years. That takes us through to 2030, right? 2030, maybe 2033. So we've got another 10 years potentially of this cycle left. And no one sounds an all clear. No one says, okay, that's it, we're out. You can get long again. It doesn't work like that. These things tend to have a climax. And could the war in Ukraine be the climax? Potentially. I doubt it. It doesn't feel significant enough to me. It's significant to obviously the people there, and it is significant in its global importance, but it it hasn't involved enough people. It hasn't led to the dismantling of institutions because people are so fed up with this cycle. So if you think about these turnings as reaching crescendos, then your point is valid, but what it means is we're heading towards the worst period. It's building and building and building. And yes, we only have, let's say we've only got 6 years left, or 7 years, if it's 2030, 22 years. Those 7 years are likely, if the framework holds up, to be of a magnitude greater than what we've experienced, not worse. These things don't tend to tail off. They tend to climax. World War II was a climax. The Civil War was a climax and a clearing event, and society and the social contract was rewritten, and maps were redrawn and boundaries were reset. And I haven't seen that happen yet on a broad enough scale to think that we've reached the end of that yet. And so I fear the worst is to come. I hope it doesn't. No, I mean, I'm not hoping for this to happen. Geez, I hope we get through it. And so if someone tells me this is it, all clear, I'd be the happiest man in the world. But I fear that we're not there yet. I fear that the denouement of this cycle will be chaotic and cathartic, as they tend to be. And like Justice Potter Stewart famously said when he was ruling on pornography, I can't describe it, but I know it when I see it. And I think we'll know the end of the fourth turning because we'll be signing peace treaties and we'll be rebuilding things rather than in the process of tearing them down.
Bringing the conversation to perhaps less significant, but sort of more relevant for a discussion about the markets. Do you think that the Fed's forecast of 3 rate cuts in 2024 should be believed?
Look, it's an interesting question. I mean, there has been the Fed has spent a great deal of time and capital over the last 15 years trying desperately to get everybody to believe everything they say. This was the whole idea of forward guidance. They realized that if we can get everybody to blindly believe what we say is going to happen in an unknowable future, then we can keep market behavior within the buffer rails down the side of the bowling alley, and we may bounce between them, but we won't get crazy on this side and we won't get crazy on that side, and that'll be much better for everybody. And they spent an awful lot of money, trillions of dollars, in terms of building up their balance sheet to drive home this message that you need to believe us, lower for longer, et cetera, et cetera, et cetera. And it worked. In certain ways, it worked. It certainly fostered animal spirits. It certainly persuaded people that it was incredibly safe to take on enormous amounts of debt because rates would stay low for longer. And then obviously, as they are just about at every major turning point, they were proven to be completely wrong in what they said about inflation. All that hard work was undone because demonstrably they were completely and utterly wrong about what they said was going to happen. And they were forced to change their behavior. Now, that shook the confidence of a lot of people, and we saw that reflected in what happened in the bond market through 2022, 2023, because suddenly the people who'd said, don't worry, believe us, were wrong and had to do things that were incredibly dangerous to what people had done as a response to believing the Fed. But the hope still shines through that, the next time they tell us that rates going to be lower, we can believe them. And of course, the incentives are juiced very much in that direction, because if you believe the Fed that rates are going lower, there's a lot of money to be made. Because as we've seen, lower rates and zero cost of capital tend to float asset prices higher. And so people are much more willing to believe the Fed when they say we're going to come and cut rates because it's in everybody's interest for that to happen. I suspect they will cut rates. I suspect they'll be forced to. And I suspect the market will begin another party. But I think that party will likely be much shorter lived this time. And the problems that the Fed have stored up in terms of the sheer amount of debt, in terms of this kind of inflationary pulse that they're trying to suppress, that cutting rates is really not going to help. The wage price hikes that people are demanding, the commodity price supply demand situations that tend to suggest that energy, while it's not going anywhere crazy now, could spike higher again. There are all kinds of things that could prove the Fed to be wrong and force them to not cut in the way they have before, to go back to zero. I doubt very much they will want to go back to zero. So we'll see. Historically, Fed cutting cycles have not portended too much positive for particularly equity markets. If you look back at the charts, you'll see when the Fed starts cutting rates, it tends to be poor performance from equities. And I suspect that the economic cycle will matter. And so, as much as we love to believe central banks when they tell us you're going to get all the free money you want, it's harder to believe them when they say, interest rates are going to be double digits and we've all got to tighten our belts. Nobody wants to believe that. So we'll see. I think they'll be forced to cut, but I think those cuts will be short-lived. And the data out today, recording this on January the 17th, we've seen hot retail sales data today, which doesn't make it easy for them to cut. So the data is very noisy, but I think blindly believing central banks, it's going to take some time for them to gain everybody's trust. I think even though people want to believe them, I think they've all got one finger on the sell button and watching inflation in case it comes back again.
And are you in the camp that believes that inflation will come back again, or are you agnostic on that?
Look, there's two questions, right? What do you believe will happen, and what do you do about that? And I believe there is enough stored up pressure to send prices higher that it will be a problem again. And I think the size of the deficits is a problem. I think there are, again, a lot of cycles, if you want to refer to them as those, coming together that suggest that the US is going to struggle to maintain rates lower just by moving the Fed funds rate. I think investors are going to demand higher rates from US debt, and that kind of setting of rates by the market is the problem that we have to face, not necessarily where the headline rate is from the Fed funds. So I think there's a good chance that inflation comes back. I think if it does, it calls an awful lot into question because, as I say, the Fed are going to struggle to justify sitting on their hands if prices start going up again. They will be forced to move, particularly in an election year. Inflation is the one thing that, as a politician, you are incredibly scared of because no matter who's in power, if inflation is a problem, they get voted out. It doesn't matter. It's just the one thing when people can't afford to feed their family or put roofs over their head or heat their homes, they get angry and they vote for the other guy, no matter who he is. So yeah, look, I get why people want to believe the Fed. I get why people do believe the Fed, and I think they may be right. The question is, what do you do about it if they are right? Do you just say, again, the all clear sounded, and we can just go long assets again because rates are going to go to zero and we're going to be back as we were? I think that is highly, highly unlikely.
Talking of the US election, Donald Trump scored a decisive victory in the Iowa caucuses against his Republican rivals earlier this week. Do you see him going all the way to face off against Biden? And which of the two do you think would be better for the US economy and stock markets?
Yeah, what a terrifying choice. Yeah, look, I've yet to see a credible case where Trump isn't president at the end of this. And I don't have a dog in either camp. But everything I see suggests to me that Trump will be the president again. I think Biden is a lame duck candidate. I think he is at this point, to me, it's elder abuse. I look at him, his cognitive ability I look at what's happening, and I'm shocked, frankly, that that he's still in that seat, and that to me speaks to another problem that the Democrats have, in that Kamala Harris is not a credible president. So you have a president and a vice president who you need to find a way to step aside and move aside, and then bring in another candidate. That's going to be a very difficult thing to pull off, because you're effectively admitting that neither of the top two jobs are capable of running the country. And so the Democrats are in a bind. They've tried in the recent past to float Gavin Newsom to kind of run that flag up the poll and see what people thought, and he was kind of roundly rejected. There's all kinds of talk about, Michelle Obama being thrown into the ring, anybody that we think can win votes. So the Democrats have got their work cut out. There's no two ways about it. And if the economy continues to deteriorate the way it has done, and the public start to, voice their displeasure, which they're doing in the polls. If you look at the polls about how Americans view Biden's handling of the economy, his ratings are dreadful, as is his overall rating. We're back to kind of the lowest of George W. Bush's presidency. So the way I see it, I'm looking for evidence of a credible reason why Trump won't be the president at this point. And that is not something that fills me with any kind of happiness. I think Americans are tired of the political system. And again, this comes back to the fourth turning and this loss of faith in institutions. And a vote for Trump, for a lot of people, is going to be with their nose held, and it's going to be a vote against the incumbent political system. It's a vote for the outsider. It's a vote for the guy who will tear down the institutions and who will, drain the swamp. Whether he does it this time or not, we'll see. But yeah, right now, I want someone to make me a really strong case as to why Trump won't be president, and even seemingly him being in prison is not going to be enough potentially to stop him. So we'll see.
I heard Oprah Winfrey's name floated as well as a potential candidate that there
So
was
there you go,
somehow
right?
airdrop
That
in.
tells you all you need to know. That shows you that this is now a popularity contest. Who is the most popular left-leaning person that we can find that we think people might vote for as a protest against Donald Trump? That's not a credible political strategy. And the fact that people are seriously floating the Michelle Obamas of the world, the Oprah Winfreys of the world, tells you the bind that the Democrats are in. And I think the bind they're in is too big to get out of between now and November. I mean, look, the conventions are way away, and there is precedent for the president stepping aside. And if he had a strong vice president, I would absolutely suspect that would be what would happen. There would be a story about, his doctors have told him that he shouldn't continue and he's perfectly fine, but perhaps it's time to step down, and hey, look at this great candidate who's going to run instead. That's very plausible. Kamala Harris is not that person. I mean, with all the will in the world, you cannot put her forward as a serious candidate to be president of the United States. So the Democrats are in a real hole here.
Yeah, I've heard that position put forward many times, but I don't know exactly what it is that Kamala Harris has done that discounts her as a candidate. I mean, maybe I'm not following US politics closely enough, but I don't think I remember any scandal that she was involved in or anything.
Well, it doesn't need scandal. I would, the first thing I would say is the fact that you haven't seen much of her is a big sign, because with Biden as impaired as he clearly is, you would think that the vice president would be shoved forward by the Democrat Party to be the face of the party a lot more than she is. So the fact that you haven't seen much of her tells you a lot. The other thing I would suggest you do is just go and Google and pick any two speeches she's given at random, any two. I don't care which ones they are, and watch as much of them as you can, and then come back to me and tell me if you still have any questions.
All right, that'll be my homework assignment then.
Yeah, I think you're better off continuing to read your World War II books, frankly. Go for it.
You said before that you believe we're in an everything bubble. So how exactly do you define that? Because it's not the case that all assets are at an all-time high right now. For example, Chinese stocks are trading cheaply. Some commodities like platinum and palladium are down in the doldrums. Bonds have taken hits. The British FTSE 100 is down over the last 12 months. REITs, utilities, they all look cheap. So is everything in the phrase everything bubble mainly just in reference to the magnificent seven tech stocks, or what does that really mean?
No, it's definitely not that. I mean, obviously, there's been a lot of damage done in the last year or so, and so the everything bubble talked about. If you went back to, I guess, go back to 2021, and it's not so much things at all-time high prices. It's more a question of things trading at artificially inflated values. Um, and I talked with Mike Green about this recently. This idea that people are very much confusing price with value, and the price is not the value, and it very rarely is. In fact, the price fluctuates around the value. Sometimes it trades above, sometimes it trades below. It's very rare that it trades in line with value. And so we have seen in the last 18 months, as rate pressure has increased, it starts to refocus people's minds on value rather than price. And so we have seen expensive assets start to fade. We have seen bond markets struggle because suddenly value matters, not price anymore. The Magnificent Seven have continued their powering forward, and Mike's work on the passive bubble explains an awful lot of that. There's just a relentless bid for these things. But that too seems to be turning. Mike again has done some work on that suggests there's outflows from Vanguard, which is an interesting thing to start watching. So the everything bubble really was this idea that we've just had a whole slew of asset prices trading at vastly overvalued levels based on and predicated upon cheap money and lower rates forever. That has changed. And it takes a while for it to work its way through the system. We saw how quickly it can go when the bond market had this meltdown at the beginning of the year in March. And of course, that meltdown hasn't gone away. Those losses are still on the bank's balance sheets. They just haven't had to mark them to market yet. Bank of America, I think, talked about having a $130 billion hole in their balance sheet if they mark their treasury bonds to market. So it's stored up a lot of this pain has been stored up and not recognized yet. And the everything bubble has definitely burst, and it's been in the process of bursting for the last year. And that will ripple through in different directions at different times. It doesn't all collapse at the same time, but suddenly the focus is returning to value rather than price. And so you will see corrections. I mean, look at something like AMC. AMC is a really good example of this because it was part of the everything bubble. There was a great narrative around AMC about what the CEO Adam Aron was going to do and how the apes are going to stick it to Wall Street, and it caught fire, and that meant that the stock traded at a price nowhere remotely connected to its value, and it did that for a while, and now the price is important, and it's trading below where it was when all the fuss started, I think, and so that's what it looks like when focus returns to value, not price. But the interesting thing is this time around, again, it's this narrative, the power of these narratives, because if you wade into the cesspool that is AMC on Twitter, for example, you can see that the less sophisticated players in that market still don't understand what's happened in the last 18 months. They don't understand what the CEO has done in terms of taking advantage of unsophisticated investors to pump his stock price, to sell shares, to do everything he can to keep this company alive. All of it, I suspect, within the bounds of the law, but just. Is it ethical? Absolutely not. Does he know what he's done? Absolutely he does. And in fact, it's not something I get involved in or comment on, but I saw the price chart the other day in AMC, and I tweeted the price chart and I tagged Adam Aron and I said, shame on you. You know exactly what you've done here. And amazingly, I had a whole bunch of people tweeting me who are obviously in the ape community, piling on me and calling me all kinds of things when, I was actually, what I was trying to say was, he has fleeced you and I feel bad for you. And, you should have some recourse to this guy. And instead they're defending him. They're defending this guy who, because they don't necessarily understand what he's done and why he's done it and the effect it's had on them, believe that they're still sticking it to Wall Street and believe that this guy is doing this for them. It's a great
Well,
shame.
what else can you expect from a community that self-identifies as apes?
Well, yeah, look, I think it's easy to kind of throw that stuff around. These were people who coalesced around an idea and were intent on making money. It was about making money first. It became more of a diamond hand situation later when the stock price started falling, and we need a cause to keep us all in this, because if we do sell, then this thing's finished. So we had to find a narrative around which to hold onto the stock, which they did. Um, and I feel nothing but sadness for this. I really do. I think what's happened is the worst of markets, and the fact that the SEC hasn't stepped in and done something to protect these investors from themselves, and from the the behavior of Adam Aaron and the board at AMC, I think is a great shame. And I suspect when all's said and done, there will be class action lawsuits and all kinds of things when people actually crystallize the loss. And some white shoe lawyer says, I'm putting a class action together because, hey, you apes, you got screwed by the CEO of the company, right? And if you join this class action, we can get your money back. I suspect they will all join that class action and try and get their money back, because why wouldn't you? It's just a shame. And again, this is the sort of stuff that happens. This is the stuff, coming back to the full term, that leads to loss of faith in institutions, loss of faith in the stock market, loss of faith in corporate governance, a loss of faith in the SEC. And that loss of faith has to be complete before we say, right, there's got to be a better way of doing this. And whether it's armed conflict or securities market regulation and policing, we need to reach the point where people say enough already. There's got to be a better way to do this.
Often when people talk about an everything bubble, the logical conclusion is that you should be out of the stock market and maybe in money markets, or more often gold. But gold is already close to an all-time high. So do you think there's much more upside in the short term? And how dependent is all of that on completely unpredictable geopolitical factors like the war in the Middle East and in Ukraine?
Uh, yeah, I love this question, and I can already hear people in your audience saying, "Oh, we know what he's going to say. He's a gold bug." I get that. Um, Look, it's an important question, but it's not. Again, it's not a simple question of price. When you talk about gold being at all-time highs, yes, it is, and it's at all-time highs in so many other currencies apart from the dollar. Um, but gold is there are different ways to think about gold. If you think of it in price terms, it's no different to Apple shares or copper or German bonds. If you think about it in terms of the price of a financial asset, it just blends into everything else. To me, there's a very different way of thinking about it. Gold is pristine collateral. Um, it's nobody's obligation. It is, if you own physical, and I'm talking physical gold. I'm not talking about ETFs or anything else. I'm talking about physical gold. You have a money good piece of collateral that there will always be a bid for, and that will preserve your purchasing power. To me, that's the important thing, because if gold fell from 2000, let's say it's $2,000. Let's say gold fell 25%. Let's say it fell to $1,500. But the S&P got cut in half, right, which we've seen happen. This is exactly what happened in 2008, right? Gold fell roughly 35%. The S&P fell about 60%. And if you look at gold in price terms, you go, geez, my gold hasn't done what it was supposed to do for me. I thought the price was supposed to go up in times of crisis. What happened was your purchasing power in that gold, you could buy half as many units of the S&P again as you were able to at the peak. That's how to think about gold. Forget the price. The price doesn't matter. The question is, what can you exchange that collateral for? What can you exchange that asset for at a given point in time when there's stress in the market, when you think, actually, I held my gold as a liquidity reserve because I didn't trust that markets weren't going to get unsteady. What I really want is to own, I always use this example of harborside property in Sydney. My gold has fallen by 25%. The waterfront property in Sydney, because no one can get a mortgage and interest rates are through the roof, has been cut by 60%. I'm going to exchange my gold for the house. free and clear, and I'd rather own the house now. So,
But
this
sorry,
argument.
but in that example, wouldn't it have been better just to keep cash or be in a money market fund?
Well, you lose your purchasing power because of inflation at that point. I mean, yes, you're right. You can if you're nimble, but if you look at gold from 2000, and people say, "Oh, you're cherry picking," but if you look at gold 2000, which is when gold bottomed and when the equity market went through the dot-com burst, so you had like a bottom in both. Gold has outperformed the S&P handily over that 23-year period. So you could have had that gold sitting there. You could have, if you wanted to, you could have loaned it out and made some money on it. Yes, you haven't had interest on it, but there wasn't any interest. You weren't accruing dividend. You weren't accruing coupon on it because interest rates are zero. So the fact that it went to 1900 and then back to 1300 and then to 2000, at any point during that period, you could have exchanged your gold for something you decided you wanted to own better. In the European bond crisis, you could have said, well, my gold hasn't really fallen, but European bonds have. I want to own Italian government bonds now. God forbid you don't ever want to do that. But so that's really what it's for. It's not, for me, and other people think of it differently. For me, it's not something I buy because I think the price is going up. It's something I want to own as a liquidity reserve that at some point I will exchange for something I want to own more. And that's it. And the price at the time is, it's not just the price of gold, it's the price of gold versus the asset you want to exchange it for. And has gold fallen less than that, then your purchasing power is increased. And it tends to do that in periods of crisis, even though there's normally an initial fall in gold because it's liquid collateral. And so people liquidate their gold to meet losses elsewhere. It's exactly what we saw in 2008, and it will happen again. You will see this initial fall in the price of gold. But once the people who need liquidity have sold it, it tends to rally, and it tends to hold up even in the downdrafts better than the other assets that you might want to exchange it for.
Staying on the topic of gold, there have been a lot of headlines about the fact that central banks are loading up on the yellow
Yeah.
metal. And I wanted to ask you how you think that might affect its price dynamics, because if you look at a country like Argentina that has suffered with high inflation, the central bank ended up exhausting all of its dollar reserves in sort of a fruitless attempt at trying to prop up the peso's value. So if central banks globally increasingly hold gold instead of dollars or bonds, is there a risk that these banks might similarly have to sell off all their gold reserves to defend their national currencies? And if so, wouldn't that mean that gold sort of loses its role as an inflation hedge for retail investors? Because if there was pressure on high inflation and central banks want to defend their currencies, they're going to be selling gold, aren't they? Which is going to put pressure on the price.
It's an interesting question, and you've maybe jumped a little too far ahead, because that phase, if it comes, I suspect is quite a way away from where we are now. And a lot of that comes down to the reason central banks are buying gold. I think this is a really important point you've raised, because they have been. The last 2 years have been both of them record purchases of gold, in records going back to the 1950s by central banks. And it's important to understand that central banks are price insensitive buyers. They're not trying to, put cheeky bids in at $20 below the market in the hope that someone puts the paper market down and their bid gets hit. This doesn't work that way. The reason central banks are buying gold the way they are goes back to Russia crossing the border into Ukraine and the response by the US Treasury, which was to freeze $300 billion of Russian central bank assets. And we're talking now because we can't get bills through. The Biden government is floating, actually not just freezing it, but confiscating that money and selling those assets and giving the money to Ukraine. And if you think about that, never mind the latest idea, they're actually confiscating and selling them, but this idea of freezing the central bank assets, that was crossing the Rubicon, because you have this system where commodity trading countries, particularly energy trading countries, have to own dollar reserves to pay for oil in dollars. And so pretty much every central bank in the world is either a consumer or an exporter of energy. And so they hold dollar reserves. Those dollar reserves are held in the United States, where all dollar reserves are held. And so they are prone to confiscation, as the Americans proved. Should you find yourself on the opposite side of a philosophical divide with the United States. Now, it's not to say they will do it, but they have proven by their actions in February last year that they will. If push comes to shove, there is a line that you could cross that they will confiscate your assets. Now, as a central bank with dollar reserves at that point, you've got a choice to make. You can say, well, we are never going to be in that situation. We're never going to invade another country. We are never going to do something so egregious that the United States take the same action against us. And the chances are you're right. However, in an increasingly politicized world, and a world that is replete with cause after cause after cause, it could be climate change. It could be you're not going to sign up to the COP28 agreement. Maybe that pisses the Americans off. We don't know. What we do know is there are things that piss them off to the extent that they will freeze your central bank assets. So even though you think we won't reach that point, you can't take that chance. This is a national security issue now. You cannot have your country's reserves at the mercy of a foreign power. So the only way to really get around that is not to go to euros because you're still at the mercy of a foreign power. It's to buy gold. And it's to store that gold in vaults that you control. And so that's what we've seen happening. Central banks have been buying gold because it's a neutral reserve asset. No one has control over it. If you own the gold and you hold the gold, no one can affect it. And they've been doing that at a pretty steady clip. And to do that, they've been divesting themselves of their US Treasury positions at a point in time where the US is trying to fund the biggest deficits in history and needs to sell more treasuries, not less. And that slack is going to be taken up by the Fed. So the fact that central banks are buying gold is a sign of increasing weakness in the system and a sign of vulnerability of the US. And I don't think it's going to stop anytime soon because gold is under-owned by central banks across the board. And so if they want to get themselves to a sensible level in their ownership, there's a lot more gold they need to buy. And unlike bonds, you can't increase the supply of gold, not by turning a tap on. It takes a long time. And history will tell you that an additional 2%, 3% maybe comes on the market every year. So we have a supply-demand imbalance that is going to lead to higher prices.
Changing the subject, I heard you say in a recent interview that you're bullish on Japanese stocks and that you have exposure through ETFs. But recently I spoke to Lance Roberts, who's an analyst at RIA Advisors in the US. Okay, and he went so far as to say there is no future outlook in Japan that's positive. And in particular, he was concerned about the Japanese massive government debts, aging demographics, and also the fact that the central bank of Japan owns more than half of all listed ETF assets. The main bar also bonds as well. So how would you respond to that bear case on Japan from Lance Roberts?
How would I respond to that? Like, I know Lance is a great guy. I don't think Lance pays an awful lot of attention to Japan. I think he'd be the first guy to tell you he's not a Japan expert, and I may be doing him a disservice, but I doubt he has spent an awful lot of time looking at the Japanese market, as a lot of people haven't for 20 plus years. It's been an investment wilderness now for a long time. And there's been very good reasons for that. The demographics are poor. The debt dynamics are poor. And, we know all this. The central bank has kind of inserted itself into the markets in ways that are detrimental to foreign ownership. We know all this stuff and it's all there. But a lot has changed over the last 5 years. A lot has changed at the corporate governance level. Japan Inc., the companies in Japan, if you start looking at company balance sheets, you will find extraordinary companies trading at the kind of valuations that would make you salivate in any other developed country. In America, you don't get companies trading like below book value with cash on the balance sheet or trading in single-digit PEs. And these are extraordinary companies. And so corporate Japan has been forced to really get its act together and to sharpen up its balance sheets, to sharpen up its protection of shareholders, the way it treats investors. And so you've kind of very quietly had this revolution in Japan's in terms of getting the companies in shape. And I mean, a year and a half ago, I think Warren Buffett famously bought into the Japanese trading companies, which are massive companies. Back in the 80s, these were world-leading companies. Japan is still the third largest economy in the world, and it's incredibly underowned. And so if you step away from the equity market, and it is a stock pickers market, you can go in and find companies if you want to do the work, or you can buy ETFs if you don't want to do the work. The Nikkei, there's a reason the Nikkei is approaching, finally breaking out of 30-year highs, because money is being put to work in Japan. And then coming back to the central bank, the key point to make about the central bank is that with the resignation or the end of the term of Kuroda-san and the tenure starting of Ueda-san, we've had a change at the top of the Bank of Japan, which, as any good corporate CEO knows, gives you the ability to change course and imply that it's the other guy's fault what we did and we're going to do things differently now. And the Bank of Japan have talked about normalizing, about a path to normalization. And I've talked about this before, but with the Bank of Japan's rate at negative 10 basis points, they could move to positive 10 basis points. It doesn't really make a difference in the scheme of things. But the message it sends about where Japanese rates are going is an incredibly important one. Japan is still the largest creditor nation in the world, and the amount of money invested overseas outside Japan is extraordinary. It's a wave of money. And if rates are going to go towards being normal again, and we don't know what that means, but let's say rates are 1% in Japan, which still leaves them massively below where they are in the US, in Europe, in Australia, anywhere else you could think of. Just that, and the amount of capital that would bring home, to say nothing of the Bank of Japan overtly saying to the big investment houses, the pension funds, the post office, we want you to bring money home. It's a civic duty now to repatriate capital to Japan. We're serious about this. We want to revive the markets. We want to get rates up. We want to carry on the work that we've done in the banking sector, for example. The results in the Japanese banking sector are extraordinary now because they're in such good shape. So there is a big change happening in Japan, and the world isn't ready for it because Japan has been the provider of capital to the world for such a long time. The yen has been the carry trade for such a long time. Everybody has a de facto short the yen, essentially. And we saw the yen go to 151, 152. And that, I said at the time, this is such an asymmetric bet, being long the yen here. It could very quickly head back into the 140s, the 130s, and try and go back towards 100. I could absolutely see it doing that. So for me, it's a question of flows. I think the flows will be into Japan. I acknowledge everything Lance said. I do. I understand why he said it. But if you have money to invest and you want to not just buy overvalued US stocks, you want to find good companies that have attractive balance sheets, have management that have made an awful lot of positive change, have demonstrated an eagerness to treat shareholders much better, and you can convert them into a currency that I think has a tailwind behind it. It's a compelling investment case. And I think it's very easy. And I've done it for a long time. I've until 18 months, 2 years ago, I'd been let down so many times by Japan. Japan's where I started my career. So I have this deep, abiding love for the country, and wanted to be long Japan. And there have been half a dozen times over the last 20 years where I said, oh, this is it. And it's let me down every single time. But 2 years ago, I started seeing changes that suggested to me this time might be different. And so I started watching it. And in the last year, I've seen the crystallization of that. And I believe that Japan is going to be one place where when equity markets turn, you will be able to put capital to work. If the United States turns, the Magnificent Seven start to fall over. Beneath them, there's not a lot of attractive companies. Japan's a big liquid market where you can put capital to work at really good valuations and have a currency tailwind. So I with respect to Lance, and say he's a good man and I like him a lot, I just think he's wrong.
Are there any developing countries that you think could be poised for a growth spurt the way Singapore took off in the last century? I read that you lived and worked in Singapore for a while.
I did.
One example that comes to my mind, maybe Mexico, no, because it recently overtook China as the US's biggest trading partner. Are there any countries like in Latin America or anywhere else in the developing world that you're bullish on?
Yeah, look, I think Mexico is a really good example of that. I don't know enough about Latin America. I've not spent any great time. Mexico I've looked at, Brazil I've looked at, but I haven't really spent any time looking at other markets except perhaps the Argentinian bond market, which is always a basket case. But again, there's interesting things happening in Latin America. The election of Milei is, I think, fascinating. Argentina is going to be a really interesting place to watch. Would I invest there? No, not yet. But I think we could see some real change in Argentina. The kind of change that would make it a place where you might be able to very carefully investigate. It won't be something you can just spray money at. You need to be careful. But Asia, so goes the dollar, so go most emerging markets. We know this, and it remains true. I think if you get a weakening dollar, then it's always good for emerging markets, and you will probably see that. It's good for the commodity countries, and you will see that. But right now, I haven't spent enough time looking at emerging markets to say you should look at Indonesia, or you should look at Thailand or Philippines or any of these things, or anything in Latin America. I'm focused on commodities. I'm focused on Japan, and I'm focused on trying to understand when the rotation out of these kind of the Magnificent Seven type stocks is going to gather pace. 'Cause I think when that happens, that's when we'll see some real fireworks in places like Japan, where capital is going to look for a home.
I know I've already taken up a lot of your time, so let's close um, by talking about commodities, if we could, because the show's called Resource Talks. All of our listeners are very interested in mining stocks, in physical metal funds. So I've got to ask you, aside from gold, are there any commodities that you name that you're bullish on?
Yeah, look, I think you can be bullish on lithium. I think you can be bullish on uranium. You've got to be careful because it's had a hell of a run. There will be a time to be bullish copper. I don't think it's just yet. And I think, people, it's interesting to me that there's been very little talk about silver recently, with the strength in gold. Normally when you get gold hitting all-time highs, all the silver bugs come out the woodwork and start talking about how much upside there is in silver. And I think silver potentially has an enormous amount of upside. And I think that is something that hasn't really been pulled along as much as I would have expected to by gold. So I think there's potential there. But for me, I'm watching the dollar very carefully. I realize that we've had this first inflation-led pulse higher in commodities. I think they're taking a breather, and I think that we're going to have conflicting forces of weakening economies, which is bad for commodities, but also a weakening dollar, which is good for them. So I expect they'll largely tread water for the time being. I certainly wouldn't load up on commodities just yet. I think they will probably come off a little bit. But when they do, and as they do, I feel like what we talked about at the beginning of the show in terms of the Fed will be forced to cut rates. I think once they do that, I think it will be a great time to be long commodities, because I think the penny will drop to people that the Fed is in a kind of no-win situation, and they're going to have to quickly drop rates. They're going to have to print more money. They're going to have to NQT. They're going to have to increase their balance sheet again. And this might be the time, finally, that people decide, I want to own commodities, not stocks. Commodities are still as cheap or cheaper than they've been relative to equities in, I don't know how long. I don't know how far that famous chart goes back, but it's true. And so there is a lot of upside, but you've got to be careful, because if you just buy commodities and expect them to go up, I guarantee you're going to be disappointed. You've got to pick your moments. And I don't think the moment is now if you're not already in.
You mentioned uranium, which is a favorite for our audience. Are you exposed to that, and would that be through a
I'm not.
physical holding? No, not at all.
I'm
Okay.
not. I'm not. I mean, I wish I could say I own, uranium sovereigns, and I keep them in a radioactive proof safe. But I'm not. And I saw the surge in uranium, and I met with the CEO of a big uranium company in Canada a few weeks ago, and talking to him and understanding the opportunity in uranium. It's a big one, and it's a great opportunity because it's supply demand dynamics. There is a need for a certain amount of uranium every year, and there's a shortfall. It's that simple. And I suspect we're going to see more demand for uranium rather than less. And so all the dynamics for me in terms of being a bull on uranium are there. Um, I want to own the asset itself, and I want to own really well managed uranium companies, and those have had a hell of a run. So I think you need to pick your jockey in those companies, and choose the right management team and the right assets. But I think there are a couple of guys now, and I don't want to name them because it's not fair on any other companies. I don't tend to do that in public. But there are a couple of extraordinarily competent managers of uranium companies who I would be very, very happy putting my money with. Um, but I would look at it very much as a long-term investment rather than I'm going to capture a price spike and step away.
And you mentioned silver. Do you look at that in the same way that you look at gold as being an asset to keep in physical form and to not worry about its price? Or is that
Yeah,
more the
yes and no.
speculative? Yeah.
Yes and no. I mean, I own some in physical form, but for me, when gold's running, I can see why you can use silver as a great vehicle to capture leverage in a strong gold environment. So for me, I don't hold as much silver as a liquidity reserve. I'll be much happier trading silver when gold's running, buying it with a view to selling it at a higher price, rather than buying it with a view to holding it. Gold, I just want to hold as a liquidity reserve.
Okay, Grant, I can confirm it has indeed been a great privilege to speak with you and benefit from your decades of experience. Is there anything that I haven't asked you about that you'd like to mention before we wrap up?
Well, we could talk about Fulham Football Club. The real love of my life, but I think that would probably alienate most of your audience. So we'll
It
probably
would
leave that for another
alienate
day.
me as well because despite being
You're not a
British, I know
Chelsea fan.
nothing about football.
Okay,
So.
fine. Listen, you're the perfect candidate to be a Fulham fan. Then. If you know nothing about football, that's just our demographic.
Excellent. All right. And how can listeners keep up with you and your writings and videos?
Simple, two places. Grant-williams.com. You'll find everything I do on there, and on Twitter if you want to follow me. I am at TTMYGH, which is the acronym for things that make you go if you want to remember it.
Grant Williams, thank you very much for coming on the show.
Mark, great pleasure, mate. Good to see you.